Joins us now, along with Disney CEO Bob Iger, in an exclusive interview. Julia, over to you.
Wilfred, thanks so much. And Bob, thanks so much for joining us here right ahead of your earnings call. So big beat on the top and bottom line. I know lots going on this quarter, but really what drove the upside surprise?
Well, a solid quarter for the company, driven by great performance at our studio with just a tremendous lineup of films this past year, and particularly this past quarter. And then Parks and Resorts and Consumer Products had a great quarter as well. Those were the big drivers.
I know there's a lot of focus on streaming. You've been investing there. That division lost less than expected. But as we get ready for Disney Plus to launch on Tuesday, can you give us any updates on where that streaming service stands and how you plan to get it out to subscribers?
Well, it's ready to go, I'm glad to say. We tested it in the Netherlands. We'll be talking about that a bit on our call, and it was quite successful. Now, the product in the Netherlands did not have original content, but it was extremely well received, not just in terms of the number of subscribers, but the user reaction to it. Very, very navigable, meaning easy to use, elegant, great access to our brands and our storytelling. So that was very positive. We've had a tremendous marketing effort across the company with great synergy efforts and a very innovative marketing effort outside of the company. The product is getting ready to go, meaning there's a lot of original content available, a lot of library content. I think people will be extremely pleased with it when they get a chance to use it.
Any news you can give us about any distribution deals? I know there were questions about whether I would be able to download it from Amazon.
Yes, so we've distribution deals with a number of different entities. We're pleased to announce today a deal with Amazon. We have deals with Apple. We have deals with Samsung, with Microsoft, with LG, with Google. So significant progress in terms of distribution deals, and Amazon being the latest one. Yes.
Amazon, interesting, because of course they have their own content as well. So frenemies here in the streaming space.
I guess that's one way to look at it, yes.
I also have to ask you about Hulu. It's been about 6 months since you announced that you were taking over full ownership.
Full control
of Hulu. Mm-hmm. How has your strategy for Hulu evolved, and do you have anything to announce there for us today?
I do. The strategy for Hulu is evolving. We have a big announcement to make today, and that is that we're going to create a huge FX presence on Hulu. FX, a highly regarded channel, a number of different accolades, particularly in terms of, I think, recognize the quality and the boldness of their programming. Since 2014, they've had 277 Emmy nominations. They've won over 55 Emmys, for instance. What we're doing really is 3 things. First of all, for the first time, FX will be creating original series for Hulu. In fact, we're going to start with 4 of them. There are 4 of them in production now, and they'll be available on Hulu starting in probably late March. We're also going to enable viewers to watch FX shows on Hulu soon after they have aired on FX, just a few hours later. And then we're taking approximately 40 library from about 40 series, 17 of which are relatively recent in nature, and making them available on Hulu. And that's over 1,650 episodes of television. So tremendous presence. This will do a number of things, both for FX, but in particular for Hulu and for Hulu subscribers. There's no extra cost to this. But essentially, we're taking premium content and adding a significant more amount of premium content to Hulu.
Do you have any sense of how this could help drive subscriber adoption of Hulu? Can you give us any guidance for those numbers going forward?
We're not giving any specific guidance, but I think it's a really good thing because of the brand the FX, I think, represents, meaning the power of its programming. The quality of its programming. I think it's a great thing for Hulu, and it'll be good for FX, too.
Everything you're doing right now, putting all of this content on Disney Plus, you have more content available on Hulu. I have to ask, though, how this is changing your perspective about the health of the traditional TV business, your media networks, and how you can imagine these new businesses cannibalizing or putting pressure and driving more cord cutting.
Well, I think it's very interesting what we're seeing, and that is that viewers now have access to watch programs in so many different ways. And what I mean by that is if you look at the accumulated rating, say a hit show on ABC, throughout its run, in basically the traditional VOD space, and there's live versus live plus 3 and live plus 8, et cetera, and so on, all the way through to its presence on Hulu. Some of our hit shows on ABC actually triple their ratings within a month of the initial broadcast. So I think people are who believe that the viewership of programs is going down and not necessarily correct. Viewership programs are actually either staying the same or rising, but they're just being spread out over time and over multiple platforms. And when we look at our company, we look at a company that has live linear channels. We also have significant television production and creativity capabilities. And we have an SVOD platform in Hulu specifically, but also, of course, with Disney Plus and with ESPN Plus. So we have the benefit of creating and owning our own shows, airing them in a very significant way on the initial channel, a linear channel, whether it's a live network or a live cable and satellite channel, and then capitalizing on consumption on new platforms, notably SVOD and Hulu.
But and I understand that your SVOD, your advertising supported, and your streaming VOD service may be strong. But if you look at the health of the TV bundle with ESPN, the most valuable piece of that TV bundle, and many people say what's holding the TV bundle together, at what point will the value that people are getting on streaming mean that the TV bundle sort of loses its appeal? And are you going to be part of damaging your bread and butter?
Well, we don't believe that what we're doing is really damaging our bread and butter, to use your words. What we really are doing is really a couple of things. First of all, we're giving consumers an opportunity to watch sports in new, sometimes considered more modern ways, more convenient ways. We're also establishing a path for us to continued, basically, success or profitability should the initial or the traditional business model be disrupted to such an extreme that it's a necessary transition that we have to make, so we're prepared for that. The MVPD, or expanded basic MVPD model, is still very important to us and to others in the business. It drives a lot of revenue, it drives a lot of profitability, it drives a lot of consumption. We've talked a lot and quite candidly about erosion or sub-losses. They continue, which is all the more reason why we're doing what we're doing.
And just a quick couple of questions about the competitive landscape. Just last week, HBO Max unveiled many details about what it's doing, including a focus on younger viewers, and in addition to kids content, but millennials and younger viewers and kids content, and a much higher price tag than what Disney Plus launches. What do you think of that as a competitive offering, and will it impact your subscribers?
We're not focused that much on the competition. We're focused on making sure that the product we're bringing out is both successful from a bottom line perspective, but also successful from a consumer perspective. We've got something that's incredibly unique. I talk about it a lot because of those brands, Disney and Pixar and Marvel and Star Wars and National Geographic, and 30 seasons of The Simpsons, and great library content, great original content under all of those brand banners. There's nothing like it for a price of $6.99 a month, which is incredible, or $69.99 a year. Or you can actually bundle 3 services, ESPN Plus, Disney Plus, and Hulu, for $12.99 a month. That's a good deal.
Reed Hastings said just yesterday that he does not consider subscriber count the measure of success, but rather how much people are viewing. What will be the measure of success for your streaming services?
Well, it'll be a combination of things. We're clearly going to be focused on subscriber count. Consumption or individual consumption will be of interest to us, and ultimately profitability, of course.
Profitability, of course. And do you have any updates now that you're seeing people sign up early of how soon that might come?
We're not saying anything specific today about how many people have signed up early, and we're not changing our guidance either.
Reed Hastings said that he will subscribe to Disney Plus. He'll watch. Have you subscribed to Apple TV Plus? Are you watching your rivals?
Well, that's nice to hear Reed say that. That's a ringing endorsement. I'm a Netflix subscriber. I can admit that here publicly. I also have availed myself of Apple TV Plus as well. I got that for free because I got a new device.
There you go. And just a last question, because I know you have to run off to your earnings call.
Yes, that would be a good idea.
There's been a lot of talk about how many different people are watching at the same time. And Reed Hastings for many years said he wasn't worried about piracy. He wasn't worried about password sharing. What is your approach going to be to piracy and password sharing?
Well, I think it'll be similar to what others are doing. It's obviously something we'll be mindful of. We're setting up a service that is very family friendly. We expect families to be able to consume it. You can have 4 live streams at a time, for instance. We'll watch it carefully with the various tools, technology tools that we have available to us to monitor it. But it's obviously something that we have to watch.
Well, thank you so much for taking the time with us today. We really appreciate it.
Pleasure.
And we'll be tuning into your earnings call, which starts shortly. Thank you very much, Bob Iger. Guys, back over to you.